Welcome to the weekly Santu Pirls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart for November 20th, 2016. Market breadth. With this past week's market advance, our Bull Bear Point and Figure ratio at 1.32 rose from 1.21 last week, advancing further into bullish territory. The total count of securities in bullish or bearish patterns decreased fractionally to 31,112. The count of bearish stocks decreased 5%, while the count of stocks in bullish patterns increased 4%. The Santu Pirls PNF Market Breadth Summary Chart shows us a market now 2 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly email version of the Santu Pirls Stock Market Commentary free of charge, simply enter your email address in the space provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, rose 267 points for the third advance in 16 weeks. At a negative 154.08 points, it continues below all 5 tops above plus 100, has risen above the January 2015 bottom, and continues above all 5 remaining bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 2 accumulation days and 2 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on higher average daily volume. Momentum. Now at a positive 130.53, up from a positive 22.13 a week ago, with 6 days above zero at Wednesday 11/16 close. The CCI 20 daily is now in a Woody's uptrend and outside the plus or minus 50 range for a valid zero line reject long entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 29 weeks ago, while the daily CCI 20 began a Woody's uptrend this past week. The CCI 20 weekly has risen to a positive 86.0 from a positive 37.71 last week, continuing from the Woody's zero line reject long entry signal within the plus or minus 50 range at Friday 11/11 close. We will follow the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and 3 of the bottom 5 are negative. Summary: banks, brokers, and some tech on top. Gold and silver, some tech, and REITs on the bottom. Bullish: KBW Bank, brokers, and disk drives continue in the top 5. Gold and silver continues to lead the bottom 5. Bearish: oil services has entered the top 5. REITs and Comp Tech continue in the bottom 5. Networkers has left the top 5. Focus this week. from www.zerohedge.com. What the worst bond rout in 15 years means for stocks. The following are some key points and charts. In light of the dramatic spike in interest rates since the Trump victory, whereas we reported yesterday and as Bloomberg comments overnight, quote, yields on benchmark 10-year treasuries posted their steepest back-to-back weekly increase since 2001, end quote, leading to the, quote, worst rout in the fixed income universe in 15 years, end quote, and which, coupled with a surge in the 10-year break-even rate, a gauge of U.S. consumer price expectations, to the highest in more than 18 months, has led to the biggest and so far unanswered question on Wall Street traders' minds. At what level will rising interest rates pressure risk assets and become self-defeating, leading to a broader market sell-off? Yesterday we presented out one argument from SocGen, shown in the table below, which tried to answer this question and found that there is still some modest breathing room of just under 30 basis points for U.S. 10-year yield before bond yields start hurting equities. However, as we also showed in light of yesterday's market performance, this critical inflection point may have already arrived because on Friday, for the first time since the Trump election, stocks and bonds both fell at the same time. At a strictly macro level, the answer how much further bond yields can rise before shattering the eerie stock market calm will likely be answered shortly. However, in addition to macro, one should also consider the micro, and it is here that the ongoing bond rout may have more far-reaching consequences. Recall that 1 month ago, we posted a warning from Barclays, according to which the party is almost over as payouts exceed cash flow by $115 billion. The implication was simple. With companies relying extensively on debt to fund stock repurchases, rising rates may soon put an end to corporate repurchases, which, as Goldman recently said, were the biggest source of equity demand in recent years. A far troubling take comes courtesy of another recent report by Goldman's Robert Borgerdi, in which the strategist makes an outright call to avoid the leverage and payout bubble. Indeed, Goldman explicitly called the upcoming debt-funded stock repurchasing frenzy one set to match the higher on record, a bubble. However, the one bullet which, in a time when rates are again expected to rise sharply, is the most critical of all, was the following. Corporate debt levels have more than doubled since 2007, and 2016 is on pace for another record year of investment-grade issuance. Interest expense is up a more modest 40%, as the cost of debt has fallen from near 6% to less than 5% at the end of 2015. The chart above shows that, at the corporate level, the biggest risk is that interest expense payments, shown by the gray line, which is a function of the average interest rate, jumps sharply as it catches up to the dark blue line, the relentless record increase in total debt, which has been the biggest catalyst for both the historic increase in stock buybacks and, by implication, the record level in the S&P 500. Sadly, over the past 7 years, most corporations that had the ability levered up to levels that are simply unsustainable during times of renormalizing, that is, rising interest rates. For now, neither the market nor, for that matter, the Fed appear to be too worried about the risk of rising rates choosing instead to focus on the favorable outcomes from rising inflation and higher rates. However, should last week's bond rout continue at a similar pace in the near future, what was until recently smooth sailing for stocks, as virtually every other asset class saw unprecedented volatility, is about to turn quite violent. Thank you for watching this week's Sand to Pearls Stock Market Commentary video featuring the proprietary Bull Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up. Wishing you a very happy Thanksgiving weekend, and always wishing you true success.